All right, welcome to This Explainer. If you work in corporate tax, you already know the fundamental, everyday headache of every single engagement. Clients don't just hand you a neat, perfectly calculated number called taxable income. I mean, if only it were that easy, right? Oh no, they hand you their financial statements, and it's your job to figure out how to get from that initial accounting profit to the actual number the federal tax authority is going to tax.
So, what we're going to do today is build a bridge right across that gap. On one side, you've got the accounting profit, which is typically prepared under IFRS. And on the other side, sitting way across the chasm, is a totally different number, the taxable income for the FTA. We're going to cross that gap safely together by applying the specific adjustments required by corporate tax law. Here is our quick 5-step roadmap for today. First, bridging the profit gap. Second, unrealized gains and exemptions. Third, watching out for non-deductibles. Fourth, interest and transition rules. And finally, calculating the final tax. Let's get right into it. Okay, step 1, bridging the profit gap. Every journey begins at the source, right? For us, that means starting with the net accounting profit or loss, exactly as it's stated in financial statements prepared under acceptable standards, like IFRS or IFRS for SMEs.
Think of this whole process like a giant filter. You start at the top with that raw IFRS profit. Then you filter it through a series of 5 major tax adjustments. Finally, out the bottom comes your final tax liability. You are literally just filtering that initial profit number down to its pure taxable core. Moving right along to part 2, unrealized gains and exemptions. These are the first 2 pillars holding up our bridge, and they deal heavily with a notoriously tricky area, assets subject to fair value accounting.
Now, this is a really fascinating shift in strategy. It's called the realization basis election. Generally, a taxable person can elect to be taxed on a realization basis. What does that mean? It means unrealized gains and losses on capital assets and liabilities are completely excluded from taxable income until they are actually realized. Just think about what that means for your clients holding investment property, securities, or any other assets subject to fair value accounting. It's a massive shift in when the tax bill actually hits them.
But hey, you really need to hear this warning. You have to get this election right from the very start. Because, no joke, in most cases this realization election is completely irrevocable. Or at the very least, it comes with some pretty extensive lock-in periods. You absolutely cannot change your mind down the road, so making this call requires some serious strategic foresight.
This brings us to the second pillar of our bridge, exempt income. Basically, the FTA carves out certain categories entirely so you don't get hit with double taxation. First off, dividends and profit distributions from UAE resident juridical persons? Totally exempt. Second, we've got the participation exemption. This means dividends and capital gains from qualifying foreign subsidiaries are exempt if you meet the conditions, which usually means having a minimum 5% ownership interest and holding it for at least 12 months. And finally, certain foreign permanent establishment income can also be excluded, provided you make the proper election.
Okay, on to Section 3. Watch out for non-deductibles. We're approaching the third and, quite frankly, the most dangerous pillar of our bridge.
Seriously? I want you to slow down and pay attention here. There's a bit of an unspoken rule in the corporate tax world. This specific category generates more audit adjustments than any other. As an advisor or an accountant, this is where real operational risks in painful FTA audits actually happen. You've got to be meticulous when deciding what cannot be deducted from that initial profit number.
So, here is your critical hit list of items you literally have to add back to the taxable income. 50% of client entertainment expenditure, non-deductible. Yep, that fancy dinner doesn't fully count. Any expense not exclusively for business purposes, add it back. Fines and bribes are obviously a no-go, though keep an eagle eye out for one important exception, amounts awarded as compensation for damages or breach of contract. Dividends paid, corporate tax itself, recoverable VAT, and donations to non-qualifying public benefit entities, all of these must be added back. If you miss even one of these, your final calculation is going to be completely off.
All right, Section 4, Interest and Transition Rules. This covers our 4th and 5th adjustments, starting with interest deductibility. And by the way, this is modeled very closely on global standards, specifically the OECD's Base Erosion and Profit Shifting, or BEPS Action 4 recommendations. So the corporate tax law actually puts a really strict cap on net interest expenditure deductions. You are capped at a maximum of 30% of your EBITDA. That's your earnings before interest, taxes, depreciation, and amortization, adjusted for tax purposes. Anything above that 30% slice, simply non-deductible. If you've ever worked with BEPS Action for interest limitation rules in other jurisdictions, these mechanics are going to feel incredibly familiar to you. But hey, before you start panicking about doing massive, complex EBITDA calculations, I want you to remember one magic number: 12 million dirhams. This is the general interest deduction threshold. If your net interest expenditure is below 12 million dirhams, that 30% cap simply doesn't bite. It's a hugely vital safe harbor to keep in your back pocket so your mid-sized clients don't get caught in the compliance crossfire. Which brings us to our fifth adjustment: transitional rules. For assets and liabilities you held before the first tax period even began, specific transitional rules allow certain historical gains to be excluded. You might even be able to elect to take opening carrying values at fair value. But here is the danger zone. This is incredibly easy to completely miss if you onboard a client mid-course, rather than from their very first tax period. So always ask yourself and your client, has this entity ever elected transitional relief? And if they haven't, is it still available to them?
And finally, Section 5, calculating the final tax. We made it. We crossed the bridge. We started with the IFRS accounting profit. We successfully applied the 5 major adjustments, and we have finally arrived at the true taxable income.
Now for the really satisfying part: finishing the math problem. Once you've got that pure taxable income number, the calculation is actually super straightforward. You apply a 0% rate to the first 375,000 dirhams. Then you apply a 9% rate to absolutely everything above that threshold. Subject to any other reliefs, that final number gives you your corporate tax liability before credits. The bridge is completely crossed.
So we've totally mastered the standard calculation, and you should be feeling pretty confident applying those 5 adjustments. But hold on a second. What about free zones? Free zones are simultaneously the most attractive feature of the UAE regime for a lot of businesses, and the single area where we see the absolute most filing errors. It's a completely different animal. So how exactly does this whole bridge change when a company sits inside a qualifying free zone? And are you prepared to navigate those totally different compliance traps? Well, that is exactly what we'll be tackling next time. Keep exploring, and thanks so much for joining me on this explainer.